What's going on, guys? It's Eric McAvoy here, back with another episode. Today we are talking about buying your first property. This is going to be a couple episode series going over some different aspects of buying your first property, what to look for, what are some of the steps you should keep in mind, some things that typically people don't really talk about, and what to just keep in mind throughout the whole process. So yeah, let's get to it. So buying your first property. Okay. So as we spoke about in previous episode about house hacking and living for free or living for very little, that, in my opinion, is probably one of the best routes to go if you're going to be pursuing financial freedom or financial independence, which I would assume, since you're watching and or listening, that's the goal. So we'll kind of keep that in mind, and that kind of being the main priority. All the steps are very similar. If you're gonna buy just like a regular house versus if you're gonna buy a house with the intention of house hacking. But house hacking, again, is one of my most highly recommended things to do if you're embarking on this journey towards financial independence. So buying your first property. Before you get started with anything, before you start going to look at houses, or deciding what part of town you want to live in, or deciding, what color paint you want inside, what you need to do first is speak with a lender. Find a lender. You can either use a big bank lender like Bank of America or Wells Fargo or something like that, or you can use a smaller local bank or a smaller credit union and get a pre-approval. I would highly recommend speaking to 3 to 5 banks, just reaching out to them saying, hey, I'm looking for a house. Here's my income. What do I qualify for? The lender will ask you for a lot of specific information, such as your income, most likely your last 2 years of tax returns, pay stubs, any 1099 forms you may have, and they'll be able to walk you through that process in a very detail-oriented way. But what they're going to get you is they're going to get you a pre-approval. What a pre-approval is essentially the bank saying, you can borrow up to X amount of money. So, the bank might say, okay, based on your income and based on your other debts, you've got a car payment and a credit card debt, you can buy a property up to $200,000. The reason that's so important is you don't want to go out and start looking at houses or multifamily properties, whatever, fall in love with one, and then realize you don't qualify for it. So speak with the lender, get your pre-approval, and before you go look at any property, get that pre-approval. Now, there is a caveat to that. When we get down to the property type, we're not there yet, so just hold on. Second part is the down payment. With the intention of house hacking, you're going to be living in the property, right? With that, you have 2 special advantages. You can do either an FHA loan, which allows you to do a 3.5% down payment. So if it's a $100,000 property, your down payment is $3,500. Typically, when you're buying a property, if it's not an owner occupied, which means you, the owner, are occupying the property, hence owner occupied. If it's not an owner occupied, you'll usually need 20 to 25% down. So there's quite a stark difference there between $3,500 and $20,000 to $25,000. So there's the FHA loan. There are some stipulations on that as far as your credit score and your DTI. DTI is debt to income, which is a debt to income ratio. And super quick, that basically is your income and your debts, and they see what percentage of your income goes towards paying those debts. So for easy math, let's just say you make $1,000 a month and you have $200 a month in debt payments. So you have, $100 car payment and $100 credit card payment. Okay, so $200 per month in debts, $1,000 per month in income, 200 divided by 1,000 gives you 20%, right? So you have a 20% debt to income ratio. The FHA guidelines do have some stipulations on that. Kind of varies, but usually they will lend up to 55 or 58%. That's not on you to figure out. The lender will take care of that for you, so you don't have to worry about that too much. It's just a good thing to keep in the back of your mind. So the FHA program is awesome. That's what I used to buy my triplex. I did 3.5% down payment. And then the other option is a 5% conventional loan. So the 5% conventional loan has slightly less rigid guidelines because it's not through FHA. Also, FHA is the Federal Housing Administration. Just toss that out there. So you can do 3.5% down or 5% down, both of which are owner occupied. So once you get your pre-approval, get that and then figure out what your maximum down payment would be. So if you got approved for a maximum of $200,000 and you were going to do a 5% down payment, you know you need at least $10,000 for the down payment, at least, bare minimum. However, please do not do that. Over here we have in asterisks the word reserves. Please have reserves. If you're going to go buy a property, do not spend every last penny you have on the down payment, because you're going to have some kind of expense come up and you're going to be in a really sticky situation if you can't pay to have that expense taken care of. You know, if you move into a property and 2 weeks later your water heater breaks, and you don't have any money, that's going to be tough. So reserves, I would highly recommend 3 to 6 months worth of expenses at all times, just sitting in a savings account. Now the way you're going to calculate that is, once you figure out the property you want and the price point, the lender will give you, or you can ask the lender for a ballpark of a monthly payment. So let's just say it's $1,000 per month, okay? You want $3,000 to $6,000 in reserves on top of your down payment, all in cash, ready to go before you buy the property. So 3 to 5% down payment, either through FHA or a conventional owner-occupied loan, and then 3 to 6 months worth of reserves. The next thing you're going to want to have is a real estate agent. You need a real estate agent in order to help you buy the property, but then also look for the property, and they will have a very good understanding of the area, of the type of properties that do well, and they'll just have a very good sense and knowledge of the market and the submarkets within your market. So a submarket could be like this specific neighborhood, or this specific, the west side of town is its own submarket, So having a real estate agent and letting them know, say, hey, this is what I got pre-approved for, this is what I'm looking for, and they will then do all the heavy lifting and find everything for you and walk you through the whole process. When looking for a real estate agent, if you can, try and find one that has experience working with investors if possible, and let them know that you're either an up-and-coming investor or you want to do house hacking, and then explain what house hacking is. And try and interview 3 to 5 real estate agents and just ask them kind of their experience, what they like about their job, different clientele they've worked with, and try and find one that sounds like they're going to suit you best. So far, what do we have? We have get a pre-approval from a lender, make sure you have a down payment plus reserves, and also make sure you get a real estate agent to be able to walk you through this whole process through all the nitty-gritty details. Next part, we want to talk about property type. So with house hacking, there are 2 main options you can go with. You have SFH, which is a single family home, which is what the vast majority of houses are in the US. So that's just, a regular, 2, 3, 4 bedroom house. There's nothing special about it. It's just a regular old house. Or we have a multifamily property with the small down payment of owner occupied, and it to be categorized as residential, meaning you can buy it by yourself and you can live there and still qualify for these low down payments. It can be 2 to 4 units. So it can be a duplex, which is 2 units, a triplex, which is 3 units, or a quadruplex, which is 4 units. You can buy a 2 to 4 unit property and it's still considered residential. Once you get to 5 units or more, that becomes a commercial property, and that's a totally different beast with lending, down payments, financing. So don't even consider that. And your real estate agent will tell you the same thing. So depending on your area and what works better, personally, I would recommend going the multifamily route. If your long-term goal is to have a cash flowing asset, which I assume it is, given that you're watching the channel and or listening to the podcast. So the only downside is typically they're harder to find. Now, that's not to say they're impossible to find. I found one pretty quickly. My first triplex, I found that within about 30 days of looking. And it's worked out pretty well so far. So I would recommend a multifamily property versus a single family. But if you are going to buy a single family, I'd recommend getting at least 4 to 5 bedrooms if possible. That way, the more roommates you have, the more rent you can charge, the less you'll be paying on your mortgage. And you might even be making money or, cash flowing when you live in your single family home. Another thing with single family homes to be on the lookout for are mother-in-law suites or ADUs, which is an additional dwelling unit. So mother-in-law suite, as I'm sure you guys know, is just like a separate little part of the house, typically the basement. It's got a separate entrance, its own little kitchenette, and it's basically its own little apartment. You could then rent that out separate from the main house. So, a really good example of a solid house hack would be a 5-bedroom home. One of the bedrooms is a mother-in-law suite. You can rent that out and then get 3 roommates up top, and you live in the 5th bedroom up top. So that's an example of using a mother-in-law suite. You can also do an ADU, again, an additional dwelling unit. That would be if you've got a single family home and then there's, like a little cottage on the backyard or something like that. That also works out very well because, again, you can rent that separately. I know there are quite a few homes that have, an additional little single unit. It's usually a pretty small little living space, 600 to 1,000 square feet or so, and you can rent that out. Or if you're me, what I would do is I would personally live in the smaller thing and rent out the whole house. Just because odds are that would make more money. Still run your numbers as far as rental income. With property type, you can go single family or multifamily. On the single family route, you're going to want most likely a minimum of 4 bedrooms. And if you can get one with a mother-in-law suite or an additional dwelling unit, those would also be huge bonuses. So far, when buying your first property, the first things I want you guys to look for, make sure you get your pre-approval letter. Okay, pre-approval is the bank's way of telling you how much you qualify for. Down payment, have 3 to 5% down plus 3 to 6 months worth of reserves. Another thing with the down payment, there's also closing costs. So closing costs are just a lot of fees associated with buying real estate. So there's a title fee, there's the first couple months of insurance due up front. There's there's like other fees. Typically you can talk to your real estate agent about this, but typically you can negotiate and have the seller pay those, so you're not out of pocket for that, but just plan for that. Typically it's like 3% or so of the down payment or of the purchase price ish. It definitely varies, but ballpark it at 3%, just play it safe. So pre-approval, down payment, cash reserves. Get yourself a good real estate agent who knows the area well and who understands your needs. And then look into the different property types and then figure out what type of property type you want to take on, and then be able to figure out what the numbers are going to look like. So figure out what your monthly payment's going to be, figure out what you can get in rents. The best thing I've found for rents, as far as roommates and whatnot, is Facebook Marketplace. That's the only thing I've used so far. It always gets me really good tenants and or roommates. So I highly recommend Facebook Marketplace. If that's not the best thing in your area, you can also check Zillow, you can check Craigslist. But Facebook Marketplace, at least in my opinion, is the best way to go. So, you can check out other comparable properties, see what they're renting for, and that's also where I would post it once you buy your property. So, part 1 of buying your first property, we got lender, down payment, real estate agent, property type. Think about those 4 things, do some homework if you're in this process. If you are, don't forget to comment down below. Let me know, ask me some questions. I want to be able to help you guys along the journey. If you found this video at all helpful, don't forget to smash that like button. It helps me know that I'm doing a good job and also helps YouTube share this with more people. And in part two, we're going to go over, once you've found the property, these are the things you need to know. So stick around for part two. That'll be coming up soon. As always, thank you guys for watching and or listening. This is your host, Eric McAvoy, for Your Road to Financial Freedom, signing off.